Mortgage rates are up again, I know. And in fact, rates are at an all-time high for the year. So what is going to happen to the housing market? What is going to happen to the economy? Is everything going to crash, as in doom and gloom? The end of the world is coming, or is it all BS? What's up, everybody? This is Luis. Hope you are all having a wonderful day. In this video, I'm going to explain how the inflation concerns that the Federal Reserve has are causing the mortgage interest rates to go up to all-time highs for the year. So let's jump right into it. So why did the mortgage rates increase again? Was it because the Federal Reserve just increased the funds rate by 75 basis points again? Well, sort of, yes. Indirectly, though. Let me explain. The Federal Reserve increased the funds rate because of inflation concerns, which are based off the August CPI report, indicating that inflation is still at over 8% month over month. And that caused mortgage rates to increase because the inflation concerns were basically confirmed by the Federal Reserve, and bonds do not like inflation. They will run. They're outie. And that causes a bond sell-off that drives mortgage rates up through the roof. I have another video explaining how all of this works. It's in the description. So in short, though, the root cause of mortgage rates increasing is inflation concerns. There are many factors that drive inflation. I'm not going to get into all the details, but I'm just going to focus on one. And really, it's the effects supply and demand has on prices. And I know this is super boring stuff, but please stay with me because this is something that the mainstream media and other YouTube channels are not covering for the same reason. It's freaking boring. They push the clickbait and fear-based content because that is what drives up traffic and ratings. So let's get back to it. Inflation. We all know that if the supply of something goes down, the price of it goes up. So over the last 2 years, we have had supply chain disruptions, and much of that was caused because the ports were closed. So freight was idling out at sea for months at a time. And as a business, in order to have your goods delivered through the ports, there was a premium price to pay since there was a limited number of slots open per day. So depending on how bad those supplies were needed, a supplier could charge $20,000 to $25,000 per container, when pre-2020 the cost was only $3,000 to $4,000. That extra cost would have to be recovered somehow. And you probably guessed it, right? Through the consumer with higher prices. Fast forward to the present, as the ports have opened up and the cost of fuel has decreased, the shipping costs have dramatically decreased. In May, just in May of this year, the average cost to ship a container was about $8,000. Today, that cost is averaging $4,500 worldwide. That's about 50% less. So with the cost of transportation down and ports getting back to normal, things are starting to flow nicely, and it's looking good for consumer prices. In addition, all of those containers that have been out at sea are starting to come in with all those supplies. So there is even a risk of disinflation, as companies will have to discount everything in order to sell them because they're just going to have too much. There's going to be an oversupply while the demand for goods is actually down now. Just imagine owning a store, you have all of this inventory that is not moving. Now you have more inventory coming. So as a store owner, how do you get rid of all of this inventory? Well, you're gonna have to discount the heck out of it. So all of this is happening now. So within 30 to 60 days, we will see it reflect in the CPI inflation report. Then the Federal Reserve will focus on changing direction on raising the Fed funds rate and potentially start to reverse everything and undo everything because deflation is worse than inflation. So with all of this happening, it's going to send a really clear message to the bond market that inflation is no longer an issue. Investors will be rushing to the bond market in order to get in while the bonds are, at the bottom, buy low, sell high, etc. So this is going to cause the mortgage interest rates to drop because mortgage interest rates are tied directly to the bonds. And what happens once the mortgage interest rates drop? Well, more buyers are going to enter the market. This causes the demand to increase, which will then cause the prices to increase since there's already a shortage of housing. So the takeaway here is to get into your home now while the prices have softened. 2 to 3 offers per home is reasonable because we will be back to the 40 offers per home selling $300,000 over asking. And yes, rates are high right now, but you will be refinancing early next year. If you wait until the rates drop to buy, then you will have pretty much missed the bottom. So get your savings ready and don't miss out waiting on the crash. There is no crash coming. This isn't 2007. And with that, that is all I have on this short video. I hope this information is useful, and reach out in the comment sections if you have any questions. Don't forget to hit that subscribe notification button. And thank you for listening. Thank you for watching. And I will talk to all of you in the next video. Bye now.